Hey guys, we're back for another video today. Today we're going to talk about sequence of returns risk. I know it sounds like a complicated term, but I'm here today with my cousin Drew and my daughter Olivia. She's joining us on a Friday laid back afternoon. Drew, tell us about the sequence of returns risk.
Okay, we're going to give Olivia a little economics schooling today, and we're going to let YouTube come along for the ride. No, this is our first, is this her first debut in an LTC tree video?
I think this is her first debut. Yeah, so she is all ears and she's like focused on the sticker that she's trying to get off. So we'll give her that. And Drew, why don't you jump right into it?
Yeah, I'll take the lead on this one today. And we're going to put some charts up on the screen in a minute, but sequence of returns risk is something that you need to think about if you're approaching retirement. And to give a real world example, but I'll just define it first. It's essentially if you look at early market returns, they can affect the outcomes dramatically. So let me define sequence of returns risk and how it will affect you more importantly. So sequence of returns risk is going to affect you if you are trying to remain invested in the market and early in your retirement, we have some sort of calamity that could set your portfolio back quite a bit. If you think about it, if you're 20, 30, 40 years old and your account gets cut in half, your 401k becomes a 201k. Remember that language people would give us back in the day?
Yeah, right. After the dot-com bust. Yeah.
Yep. After the dot-com, we'll talk about that in a minute. It's not a big deal, even if you're 40, because we know the market will come back. It might take decades, and there's some examples that we'll talk about, but it will come back. But if you have some sort of a crash like that early in retirement, it could set you back just almost catastrophically.
Yeah. So is it one of those things to where if all your eggs in one basket and you do have that calamity that hits the 2000 dot-com bust, the housing crisis, you want a diversification, maybe have some in the market and some in kind of a fixed asset?
Exactly. And that's where we're going with this is there are some fixed asset options out there that people really need to have a portion, a small portion, but a portion of their portfolio in. And let's just imagine if you did retire in, say, what was it, March of 2000 when the NASDAQ peaked and
I
the
think it
S&P.
was. Yeah.
Yeah.
Yep.
So, if you retired then and you over the next 18 months watched your portfolio drop by, it was 50, what was it, 57% or something like that? No, 40.
It was all 50%. It was a big number. It was a big number for sure.
Yeah, you watch your account drop by, let's say, half across all your different investments, and you're just in your first 18 months of retirement, but you don't know how long it's going to take for it to come back. And tell them, Derek, how long did it take for the S&P to come back after the dot-com crash?
I think it in 2007 it got up there, but it didn't break through and fell back again. So I think it was like 2013, 14, 15, somewhere in that range before the S&P NASDAQ kind of retraced and made new highs. It was over a decade, easy.
Yeah, and we are intentionally cherry picking these dates. So if you retired, let's say 5 years later, it was a lot different outcome. But the risk that you're running right now, if you have most of your money in equities and you're getting ready to retire, is what happens in the very first few years of your retirement can make the rest of the income that you're going to get in retirement dramatically lower if you're not invested properly. And so let's talk a little bit about the solution to this problem. It's a problem that a lot of people have. How do they solve it?
Yeah, so the solution is there's this concept called the rule of 100. And what's the rule of 100? The rule of 100 is for every age you are, so 60-year-old, you want to have that percentage of your assets in something with fixed guarantees, whether it's a CD, a money market, or in our case, equity index annuity. That's what we're here to talk about today. And the other 40% in that example would stay in equities. Now, your recipe, so to speak, could be more, could be less, but the point being is you want to begin to have a greater and greater portion of your assets in fixed investments as you approach retirement because your time horizon is shrinking. If you just think back to the past 25 years, we've had four really big events that Drew, you just outlined. We had the dot-com crash where it was down 50%. The housing crisis in 07, 08, that was another 40, 50%.
Yeah, I've got it
We
on the
had
chart. I've got it on the screen
COVID.
here. Yeah, let's run through this. So you had the 49% dot-com bust. You had the 57% financial crisis, a 16, a 19, and a 14% drop in a few years there, the 34% COVID crash. These things are happening on a regular basis.
And then we had the inflation, like when the Biden got in 2021, we had the Ukraine war and then inflation kicked in. That was down. I think the S&P was down 30%. NASDAQ was down 40%. So point being is over the next 25 years, it's almost guaranteed we're going to get some good markets, but we're also going to get some kind of black swan events we're not even thinking of. And if you had to have a diversified portfolio, when the next black swan event hits, you can start leaning on that fixed portion that does not, you don't lose principal in it. And then you can lean on that fixed portion asset to have money coming in and not have to sell your stocks low. Because what happened in each of those cases, you had to give it a few years, but it came back up. I just think back to last April, we had a little quick sell off with the tariffs. NVIDIA, which is currently trading at $180, I bought shares. It went from like 150 to like $75 in just a matter of a couple of weeks. And so we had people panicking and they sold their NVIDIA. Now it's 180. So the point, if you go back to 1 year ago, there we go. It was in like $78. And so that's what happens naturally is if you have all your assets in just one category, when something happens, people have a tendency to panic and they end up usually selling low. So this kind of almost gives you a training wheel. So when the next swoon happens, you're diversified and you have this other piece to lean on.
Yeah, and I think a lot of people they don't like the idea of going into CDs or bonds because we all know most of those actually lose real value because of inflation. And having the ability to participate in the market with some guardrails is very appealing. And it's why these particular types of plans are soaking up billions and billions of dollars, and their growth rate is through the roof. We didn't talk about annuities for decades because they weren't that good. And I even had a financial advisor call me a couple weeks ago, and he said, I never liked annuities. I said, I didn't either. And he said, and now I do. And a lot of people are coming around to the fact that because of the sort of the Venn diagram we find ourselves in with current higher interest rates and the company's able to offer more lucrative benefits, it's really compelling for a lot of people that are getting close to retirement.
Yeah. And I'm just going to give the viewers just a kind of a 1,000-foot view of how do these companies protect your principal and still get exposure money in the stock market and get higher returns, gives you a shot at a higher returns than CD. So basically, how it relates to the interest rates is the companies will take in your premium and they'll go buy typically a 10-year treasury, something like that, something with a fixed interest rate. From the housing crisis, which we were talking about earlier, to really 2022, the Fed kept interest rates near 1% for 16 years. That's the interest rate they use to build these products. So now that interest rate moved up, they'll take your 100K, they can go buy, they're going to the market with billions of dollars at one time. So they're buying massive amounts of these treasuries. So maybe they're getting 5-6%. They'll take just the interest in that one example. So they're taking the $5,000. Then they'll go buy call options in these indexes, the NASDAQ, the S&P. And if the call option hits, you make money. If it loses that year, you just lose the interest for that year. But there's no magic. They're not doing anything. It sounds too good to be true. They're using options to indirectly expose you to the market.
Exactly. The sequence of returns risk is a significant impediment to your potential retirement. Being aware of it, and hopefully this video helped illustrate what it is and how it could affect you, and knowing how to solve it is our goal. So hopefully this has been helpful, y'all. If you're curious or want to learn more about any of this, we have a couple ways to reach out to us. We have a toll-free number that rings simultaneously to Derek and I on both sides of the country here, 1-800-800-6139. Please leave us a voicemail if we can't answer, we will call you back, or visit our website at ltctree.com. So I think that kind of wraps it up. Derek, what do you think?
I think that's good. That's a good place to end. And we'll continue to dive into this topic because we know this is pretty in depth. So next time we'll have some more charts and figures and give some examples on what happens to a portfolio if you are properly diversified with equities and fixed assets compared to when you do have the swoon, compared to when you're all exposed to equities. The end result over time typically is about the same, but you don't have the ups and downs of you don't have to worry about the stress of watching your portfolio go on that roller coaster. Anyway, till next time, see you guys.